You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate script. I'm Susie.
And I'm Miro.
Today is January 8th, 2026, and we are looking at everyone's favorite garage staple, WD-40 Company. Before we start spraying lubricant on the numbers, just a quick reminder that everything we say here is for entertainment and education only. This is not financial advice, just our personal opinions. So, Miro, the blue and yellow can. Usually this is the most boring, predictable report in the pile, but looking at the tape, it feels a little slippery this time.
Yeah, slippery is the right word. Look, if you just glanced at the gross margin, you'd think they crushed it. 56.2%. That is a massive jump, up 150 basis points from just last quarter. But then you look at everything else. Revenue came in at $154.4 million, basically flat, up 1%. And the bottom line, net income dropped 8%. Earnings per share hit $1.28, down from $1.39 a year ago.
Wait, hold on. Margins are way up, but profits are down 8%? That feels like they lost money on the way to the bank. What happened?
They spent it. The cost of doing business, which is their fancy term for operating expenses, spiked to 40% of sales. Usually they target something closer to 30 or 35. So they made more profit on every can they sold and then immediately burned it on headcount, travel, and strategic investments.
Ooh, 40% OpEx on a mature industrial company? That sounds heavy.
It is, and the market hated it. The stock actually had a great day during the regular session, closed up around 3% near $203. Then the report dropped. Bam, down almost 9% in after-hours trading, falling to around 185.
Ooh, ouch. So the algorithm read the headline, margin expansion, bought the rumor, and then humans read the spending spree and sold the news?
Something like that. Plus, there's a nasty surprise in Asia. Distributor sales there collapsed, down 33%. Management says it's just timing, ordering patterns. But when a third of your volume in a region disappears overnight, investors tend to get nervous.
Yeah. It's just timing is usually code for, please don't ask about demand. But it's wild, right? You have this incredible brand power. They can raise prices, fix the gross margin, but they just can't seem to get the operational leverage to fall to the bottom line this quarter.
Exactly. It's a tug of war between pricing power and operational bloat. And right now, the bloat is winning.
All right. Well, let's see if we can figure out if that bloat is muscle or just, fat. Let's get into the details.
Right. So looking at the bottom line, it's messy. Earnings per share came in at $1.28. That is down 8% from last year. For a company that trades at this kind of premium multiple, shrinking earnings is not exactly what the bulls wanted to see.
And the top line wasn't much better, right? $154.4 million in revenue?
Basically flat, up 1%. If you adjust for currency, it's practically a rounding error. So no real growth to speak of.
Okay, so sales are flat, profits are down, but you said earlier the margins were fantastic. How does that math work?
That is the one bright spot. Gross margin hit 56.2%. That is up 150 basis points just from last quarter. It's actually a really strong number. They're benefiting from cheaper specialty chemicals. Basically, the raw goop in the can got cheaper, and they successfully pushed through price increases.
The goop got cheaper? I'm sure the chemists love that technical term. But wait, didn't they also say something about the smart straws?
Yes, the premiumization effect. This is key. Almost half their sales, 49%, are now coming from the fancy cans. The smart straw, the easy reach flexible nozzle. The ones where you don't lose the little red stick?
Oh, I gladly pay extra for that. Losing that straw ruins my whole Saturday.
Exactly. And that's their strategy. They solve a tiny annoyance, charge a premium, and the margin expands. It's brilliant. But, Susie, you can't just rely on fancy nozzles if you have a hole in the bucket elsewhere.
And the hole is spending?
Massive spending. This is the bloat we talked about. Their cost of doing business, which is just their cute name for operating expenses, spiked to 40% of revenue.
A 40%? isn't their target usually in the low 30s?
Yeah, 30 to 35. So they are way over budget. They blamed it on employee costs and timing of sales meetings. But when your revenue grows 1% and your costs grow significantly faster, that is negative leverage. That is why net income dropped to $17.5 million.
Yikes. So they're running a heavier ship, hoping the sales will eventually catch up to pay for the crew. Speaking of sales catching up, what happened in Asia? You mentioned a 33% drop for distributors?
Yeah, total Asia-Pacific sales were down 10%, but the distributor market specifically fell off a cliff. Management claims it's just timing. Basically, distributors bought too much in Q4 and are digesting inventory now.
Do we believe that? Or is the economy over there slowing down?
Well, here's the counterpoint. In China, where they sell directly, sales were actually up 8%. So people are still buying the blue cans. It's just the middlemen who are panicking.
Interesting. So the end amount is there, but the supply chain is getting whipped around.
Exactly. And meanwhile, they're sitting on $58 million in cash. So they're not going broke. But this quarter basically proved that even with a 56% gross margin, you can still miss the bottom line if you let your overhead get sloppy.
It's like buying a Ferrari engine and putting it in a dump truck. Great power, but you're carrying too much weight to go fast.
That is disturbingly accurate metaphor.
All right, that's the P&L snapshot, but I want to double-click on that premiumization thing you mentioned, because if half their sales are now smart cans, that changes the whole business model, doesn't it?
It changes everything. It's not a commodity anymore. It's a gadget.
Okay, let's dig into that, because I have a feeling that little red straw is doing a lot of heavy lifting for the stock price.
It does. Think about it this way. If you sell a generic can of lubricant, you're competing with every private label knockoff at the hardware store. It's a commodity. You're fighting over pennies.
Right. It's just oil in a tin.
Exactly. But the second you attach that permanent smart straw that flips up for a precision stream and down for a spray, you stop selling a chemical. You start selling a tool. You can charge 20-30% more for the exact same fluid just because the delivery system saves a mechanic 10 seconds of frustration.
You know, I never thought I'd hear someone describe a spray nozzle as an economic moat, but here we are.
It is, though. Look at the data. Premium formats are now 49% of sales, almost half the business. And that is the primary reason their gross margin hit 56%. They are successfully converting a low-cost commodity into a high-margin hardware product. That protects them from inflation. If the price of the oil goes up, they have the pricing power to absorb it because the customer is addicted to the straw, not just the liquid.
That makes sense. It's the iPhone strategy. You buy it for the ecosystem, or in this case, the nozzle, not just the glass screen. But Miro, if the blue can business is becoming this high-tech margin machine, why is the overall growth still flat?
Because they're still dragging around an anchor.
The cleaning brands.
The cleaning brands, Spot Shot, 2000 Flushes, Carpet Fresh. These are what they call harvest brands, which is corporate speak for businesses we are slowly letting die.
Harvest brands sounds pastoral, but the numbers aren't, are they?
No! In the Americas, sales for these home care products dropped 18% this quarter. 18. It is dead weight. It creates noise in the P&L, and frankly, it has nothing to do with their must-win battles.
So why do they still have them?
They're trying to get rid of them. They explicitly listed the Americas home care business as assets held for sale. They already sold the UK cleaning brands, and now they're shopping the US ones.
So this is a garage sale. Literally.
Literally. And here's the kicker, Susie. If they manage to sell these brands, the CFO said it would boost their full-year guidance by about 20 cents per share.
Wait, selling a revenue stream increases their earnings guidance?
Yes, that is how inefficient these brands are. They're likely dragging down the margins and distracting resources. If they cut the cord, they get a cash injection to pay down debt or buy back stock, and the remaining business, the WD-40 specialist stuff, immediately looks more profitable.
So the bull case here isn't just sell more oil, it's stop selling toilet cleaner.
Precisely. It is addition by subtraction. You get a pure-play maintenance company with 56% margins, growing in the mid-single digits, without a drag of declining household detergents.
That actually changes how I view the valuation, because right now the PE ratio looks high for a company growing at 1%. But if you strip out the dead revenue...
Exactly. Then the underlying core is growing faster and is much more profitable than the headline shows. The risk, of course, is that they can't find a buyer. Then they're stuck managing a decline.
Right. Nobody wants to buy a melting ice cube.
Exactly. But if they pull it off, the math gets a lot cleaner.
So, yeah. So let's step back for a second and think about what all this means going forward. Where does this leave them heading into the rest of the year? Short pause.
It leaves them in a bit of a high-stakes staring contest with the market. By reaffirming their full-year guidance despite this soft start, they're effectively betting the house on a massive second-half rebound.
Right, because if Q1 was flat and the full-year target is still $600+ million, the math gets steeper for the next 3 quarters. They basically have to see those Asian distributors come back roaring.
Exactly. It creates what we call a hockey stick year. Management says the Asia dip is temporary, and they expect a strong recovery. But if that demand signal doesn't flash green by Q2 or Q3, that guidance is going to get cut, and the stock will get punished again.
And then there's the spending side. You know, on the call, the CEO was beaming about their employee engagement scores hitting a record 95%, which sounds lovely, humanly speaking. But looking at the stock drop, investors are clearly not in the mood to pay for happy vibes if it costs 8% of the earnings per share.
Yeah, Wall Street is ruthless that way. 95% engagement is great for culture, but if your cost of doing business stays stuck at 40% of sales, you're running a charity, not a growth compounder. They need to prove that this quarter's spending spike was actually an anomaly, like they claimed, and not the new normal.
So it's a show-me story now. The product is iconic, the margins are beautiful, but the execution needs to tighten up.
That's the verdict. Watch the divestiture news. If they sell the cleaning brands, the narrative cleans up instantly. If they don't, and Asia stays soft, it's going to be a long year for the blue and yellow can.
Well, at least the squeaks will be gone. All right, I think we've squeezed everything out of this one.
I think we have.
All right, let's close this out.
Right. We'll see if they can fix the leak before the next quarter. It should be an interesting year for them.
Absolutely. Now, before we sign off completely, I want to pull back the curtain for a moment and share a quick note on what this project actually is. Earnings Unscripted is an experiment by a small team of enthusiastic people exploring the frontier of AI and how it can be used to enrich us. What you just listened to was created entirely by a team of AI agents, from the research analyst and scriptwriter to us, the hosts, and even a fact-checking QA specialist. We are all working together to try to deliver high-quality, up-to-date information that would hardly be possible otherwise.
It's a new way of telling stories, and we're learning as we go. So if you have questions, comments, or just want to see how the sausage is made, please reach out at earningsunscripted@datamadness.ca or follow us on X.
See you after the next call.